All right, everyone, welcome. Let's talk about accounting. Now, I know, for some of you, hearing that word might bring on a slight feeling of dread. You're probably picturing endless spreadsheets, complicated calculations, maybe some tax forms. And look, you're not totally wrong. That stuff is part of it. But that is not what we're here to talk about. We are here to completely reframe how you think about accounting. I want you to see it not as a math class, but as the language of business. It's the essential tool for strategic thinking. It's all about learning to read the story that the numbers are telling us, and then using that story to make smart, confident decisions.
Okay, let's just jump right into the deep end with a question that you will, I promise you, face in your career. Let's put you in the hot seat. You're a manager. Your team is totally swamped, they're overworked, and you desperately need more help. You want to hire 2 new people. The question seems simple, right? Can you afford it? Well, this is absolutely not a decision you make based on a gut feeling. It requires a really deep, honest look at your company's financial health. And it goes so far beyond just their salaries. I mean, that's just the tip of the iceberg. We're talking about the full cost. You've got benefits, payroll taxes, the time it takes to train them, maybe new computers or equipment, even the cost of the extra desks they'll need. This right here, this is the kind of tough, strategic question that accounting is built to answer.
And the tool we use to answer that big hiring question is accounting itself. The best way to think about it is this: accounting is the language of business. Period. You wouldn't try to write a great novel without understanding grammar, right? It would be a mess. In the same way, you simply cannot make sound business decisions without speaking the language of finance. It gives us the structure, the rules of the road, and the shared vocabulary that allows everyone, from the CEO in the corner office to a potential investor halfway across the world, to have a meaningful conversation about a company's health, its performance, and its future strategy.
So, we've established that it's a language. How does this language actually work for us? Well, it really serves 3 primary roles in decision-making. The first one, and you could argue it's the foundation for everything else, is financial planning and control. See, before we can measure how we're doing or ask people to invest in us, we have to have a plan. Great business decisions don't just happen by luck, they come from a deliberate, carefully thought-out financial strategy. This is where we draw the map for the journey ahead.
Now, what's so important to see here is that this isn't just a random to-do list. These activities are all deeply connected. They flow into one another. It starts with analyzing your revenue streams. You have to know, really know, where your money is coming from. Is it all from one big product or from lots of smaller ones? Once you know that, you can focus on controlling expenditures. And this isn't just about slashing costs blindly. It's about strategic spending, creating a budget. Are we putting our money in the right places to grow? And when you understand your income and your spending, only then can you really start to forecast future earnings with any kind of confidence. And all of this, every single step, is done with one ultimate goal in mind: maximizing profits and creating real value.
Let's make this real with a quick scenario. Imagine a small local bakery. It's famous for its amazing cookies, but the owner wants to branch out and start selling a new line of fancy gourmet cakes. Now, she can't just run out and buy a truckload of expensive chocolate on a whim. No way. First, she has to become a historian of her own business. She's got to dig into her accounting records. She'll look at past data. What were her profit margins on the different kinds of cookies? How much did the price of flour and sugar go up last year? That historical data is the foundation for a super powerful tool we call cost-volume-profit analysis. She needs to figure out her variable costs for each cake, the flour, the sugar, the eggs, and her new fixed costs, like maybe the salary for a new pastry chef. From there, she can calculate her break-even point, which is the magic number. It's the exact number of cakes she has to sell every single month just to cover her costs. That number becomes her first, most critical target.
And this quote just hits the nail on the head, doesn't it? For that bakery owner, launching a new product without a detailed financial plan is exactly like setting sail across the ocean with no map, no compass, and no idea where you're going. I mean, you might get lucky, but it's far, far more likely you're going to get hopelessly lost. That financial plan, the budget, the forecasts, and that all-important break-even analysis, that is her map. It's what guides her decisions and helps her navigate the stormy seas of the market.
Okay, so you've got your map. You've set sail. What's next? Well, a map is pretty useless if you just stick it in a drawer and never look at it again. You have to constantly check where you are on that map. And that brings us to the second huge role of accounting: performance evaluation. This is the feedback loop. This is what tells you if your plan is actually working, or if you need to change course before you hit an iceberg. It's where we take a hard look at the plan versus reality.
All right, so you're the manager again. It's the end of the month, and this report lands on your desk. Take a look. You budgeted $50,000 in revenue, but you only brought in $45,000. Ouch, that's a $5,000 miss.
At the same time, you plan to spend $5,000 on marketing, but you actually spent $7,500. Now, the immediate question I would ask my team is not what went wrong, but something more like, okay, team, help me understand the story here. We increased our marketing investment by 50%, but our revenue still fell 10% short of our goal. Walk me through it. You see, the numbers themselves don't give you the answers. Their job is to spark the critical conversations that lead to the answers.
So what happened? This is where I see a lot of students make a classic mistake. They just state the obvious. They'll say, well, we were $5,000 under on revenue. Yeah, I can read the report, thank you. That's just observation, it's not analysis. The real skill, the thing that makes you valuable, is digging in to find the why. You have to put on your detective hat. Was our marketing campaign just bad? Did we spend all that extra money on the wrong social media platform? Or maybe it was something totally outside of our control. Did our main competitor launch a massive sale this month that just sucked all the air out of the room? Your job as a decision maker is to figure out what you can control and what you can't. These accounting reports are the smoke. Your job is to find the fire.
And this brings us right to our third and final role, investment decisions. So far, we've mostly been talking about internal stuff, how managers use this information to run the business. But your company's accounting story is also being read very carefully by some very important people outside the company. We're talking about investors and lenders, and they're trying to decide whether or not they should give you their money. And believe me, their decisions are based almost entirely on the financial story that you tell.
So let's switch hats. You're an investor now. You're looking at two companies. First up is Tech Innovate Inc. Wow, look at that profit margin, 25%. That's fantastic. But hold on, look at its debt-to-asset ratio. It's 0.6. What that means is that for every dollar of stuff the company owns, 60 cents of it was paid for with borrowed money. That's a lot of debt. That's a big risk. On the other hand, you have Stable Goods Co., a more modest 10% profit margin, but its debt ratio is a super safe 0.2. So what's the right choice? Tech Innovate is using what we call high financial leverage. They're using debt to try and supercharge their returns. But leverage is a double-edged sword. It can magnify your gains, but it can also magnify your losses. See, accounting doesn't make the decision for you, but it lays out that risk versus return trade-off in black and white.
And it is so important to understand the difference between these two groups of outsiders. First, you have investors. They're giving you money in exchange for ownership, for a piece of the pie. They look at Tech Innovate's high profit margin and they see massive growth potential. They're often willing to accept more risk for the chance of a higher return. Then you have creditors. Think of a bank giving you a loan. They aren't getting a piece of the company. They care less about your massive growth dreams and more about one simple question: can you pay us back? They'll look at that 0.6 debt ratio at Tech Innovate and get very nervous. Both groups are reading the exact same report, but they're reading that story through completely different lenses.
So, as you can probably see by now, these three roles, planning, evaluating, and making investment decisions, they aren't just separate, isolated activities. They are a continuous, living, breathing cycle. You start with a plan, using your data to forecast and build a budget. Then you evaluate your actual results against that plan. The insights you get from that evaluation, the whys behind your numbers, then directly inform your next big strategic investment decisions, which in turn become the starting point for your next planning cycle. It just keeps going. It's the engine that drives a smart business forward.
And that really brings us to the single most important idea I want you to take away from our time together today. The old stereotype of the accountant. You know, the person with the green visor sitting in a dark back room, just recording things that have already happened, that is completely dead and gone. In the modern business world, accounting is a forward-looking discipline. We use the structured, reliable data from the past to get a clear picture of the present so that we can strategically build and shape the future that we want for our organization.
So I'll leave you with this final thought. As you go forward in your careers, and you will all be the ones making these decisions someday, remember this. The financial reports of your department, your division, and maybe someday your entire company, they are going to be a direct reflection of the choices that you make. So the real question isn't just about learning the mechanics of accounting. It's about learning how to use it to write your own story of success. So as a future business leader, you have to ask yourself, what story do you want your numbers to tell?